Anyone chasing worldwide dividend diversification eventually stumbles into emerging markets. And right away you notice how few dividend ETFs actually exist here. But there is one giant that everyone seems to buy: the iShares Emerging Markets Dividend ETF. Today, we're going to break down what this ETF is all about. I'll tell you honestly what I think of it, the type of investor it fits, and whether I'd buy it myself. This is not financial advice, just my personal opinions and experiences. Today, I'm using Extra ETF almost exclusively because it gives us all the data we need and presents it in a clean, visual way. Let's start with the basics. We're looking at a physically replicating ETF that's grown to over 1 billion euros, a very respectable size. Inside the fund, you'll find roughly 100 holdings, which gives you a solid balance between diversification and focus. What immediately stands out are the unusually high costs of 0.65% per year, something you really don't see often. But if you look at the tracking difference since the ETF launched, the average comes in at 0.41%. That's the real cost investors have paid, meaning the fund has historically been cheaper than the TER suggests. Overall, the ETF is very popular. Here you can see the number of shares sold. Since 2022, that number has almost tripled. All right, let's take a quick look at the fact sheet to understand how the ETF selects its companies. The fund seeks to track the performance of an index composed of 100 stocks with leading dividend yields selected from emerging markets countries. So the only thing that matters here is getting the highest possible dividend yield. There are no additional quality filters. And that tells us something important. We should not expect high-quality companies in this fund. This usually means we're trading away price appreciation and dividend growth in exchange for immediate cash flow. And these are the top 10 holdings of the ETF. Brazil, China, and Poland are heavily represented here, mainly with companies from the energy and financial sectors, classic high-yield areas. Overall, we're looking at companies that most investors have never heard of, which isn't necessarily a bad thing by itself. But when you check the price charts of these individual stocks, you quickly notice that their performance hasn't been impressive at all. Don't be shocked. I'm now showing you the ETF's pure price performance since launch. Okay. Let that settle for a second. We'll come back to it later. Here's what the ETF's country allocation looks like. What really stands out is that Brazil has the largest share. Apparently, Brazil has a lot of old economy companies that pay very strong dividends. The sector allocation is also exactly what you'd expect from a high-yield dividend ETF. No big surprises here, and nothing to complain about either. If you enjoy my content, a like and subscribe means a lot. Thanks. This ETF has been on the market since the end of 2011 and has delivered an average annual total return of just under 5%. That's weak. To put this into perspective, here you can see a total return comparison between this ETF, a standard emerging markets ETF, and Vanguard's Vanilla Dividend ETF. The comparison goes back 10 years, and I think it clearly shows where this ETF's performance stands. Now let's take a closer look at the performance chart of this iShares Emerging Markets Dividend ETF. In red, you see the pure price performance, just like we saw earlier. In blue, you see the total return, meaning price performance plus dividend payouts. And now it becomes obvious that dividends are doing almost all the heavy lifting here. Without dividends, this investment would have been a massive loss. And now it gets interesting, because we're moving on to cash flow, the main reasons this ETF is so popular. Payouts happen quarterly in March, June, September, and December, which is exactly when most other ETFs also distribute. Here are the dividend yields the ETF has delivered since launch. Not bad, is it? What stands out is that the yield has increased over time and recently even crossed 8%. That sounds great, right? Well, not really. Check what happens when we look at the actual cash payouts. And as we can see here, there is no growth at all. Actually, the opposite. The very first payout, which was 13 years ago, is higher than the most recent payout in 2025. So, not only is there no growth, but the payouts are incredibly inconsistent from year to year. Honestly, I'm not a fan of ETFs with payout patterns like this. I want stable and ideally rising dividends. But let's come back to the dividend yield. The reason the yield has gone up over the years is very simple. As we saw earlier, the ETF's price has been falling steadily since 2012. And since the yield is calculated based on the price, it's actually rising for all the wrong reasons. It's a classic sign that we might be looking at a dividend trap. Now the question is, why do people buy this ETF? The reason is obvious. The high dividend yield is simply hard to ignore for many cash flow-focused investors. Here's something interesting. This is how the fund's assets have developed over the years. Until late 2022, the ETF was flying under the radar. Then, suddenly, a wave of new money flooded in. But why? Let's look at the price chart again. Exactly during that period, the ETF was cheaper than ever before. Anyone who bought at that point locked in a personal dividend yield of around 8%. Not bad, assuming the yield is the only thing you care about. So, should you still buy this ETF? And who is it actually suitable for? Look, nobody has a crystal ball, but given how much it has already fallen, there's a decent chance the worst of the price drops are behind us. Anyone buying today is locking in a very high personal dividend yield, and I can see why that's tempting. This fund is for the investor who wants emerging markets exposure and prioritizes maximum current yield above all else, even if that means their capital stays flat or even loses value over time. Everyone has a different strategy, and you should do what fits your goals. Just remember, this is just my analysis, not financial advice. At the start of this video, I promised to tell you if I'd actually buy this ETF. Well, if you've watched the previous chapters, then you already know I'm not a fan of this ETF. An investment that keeps losing value year after year is simply not an option for me. That's just my personal view, but I prefer dividend ETFs that don't blindly pick the highest yielding companies and instead apply at least some level of quality screening. The second thing I don't like about this iShares ETF is the inconsistent payouts. If I'm investing for the long term, I want stable cash flow that ideally grows every single year. To be fair, there aren't many emerging markets dividend ETFs out there, but these two look much better to me. The Fidelity Emerging Markets Quality Income ETF and the L&G Emerging Markets Quality Dividends Equal Weight ETF. Both focus on quality and offer stable distributions. The catch? Their yields are only about half as high as the big iShares fund. And both still have very small assets under management, even after several years. Think about it this way. If I were only chasing maximum yield and didn't care about growth, I'd probably skip emerging markets entirely. I'd look at a covered call strategy like iShares WINC instead, which delivers high income without the same structural price decay. All right, that's it for today. Do you invest in emerging markets? What do you think about the iShares Emerging Markets ETF? Let me know in the comments. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.